Hi, Steve Sosnick here with today's Interactive Brokers Morning Market Morsel. Well, the chaos continues in the markets, and we're seeing the back and forth that we started, that really has characterized the last week and a half, 2 weeks, 3 weeks, however you want to look at it. Um, Remember, a couple things here. Volatility works both ways. We had the big move down, then the big move up, and now we're seeing it go down again. Amazon being very instructive, right? Microsoft had great cloud numbers, so basically the market took the price of Amazon up, figuring that if Microsoft is good, Amazon will be better. And it wasn't necessarily. Their top line stuff was below expectations, and it gave back all those gains. This is the kind of stuff you see in a very disjointed market. The technique that has worked for investors so much over the last basically 10 years is buy the dip. And the most dangerous phrase that one can use in the marketplace is, it's different this time. And I'm going to use it now. And I don't use that lightly, and I'll tell you why. What is different this time? You can still buy the dips. There will be a point where you look back and go, geez, I wish I bought here. But I think now it's really switched to more of a trading mentality. Buy the dip, sell the rip. You got to add that second part in. Before, more or less any sale was a bad one in the long run. But I don't think we're at that point now. I think the market's trying to establish a range. The 200-day moving average has started to roll over. And most importantly, you don't have the backdrop of an uber-supportive Fed. The Fed is not just throwing money at the markets right now. And the effect of the tax reform, which gave huge incentive for companies to be buying back their own shares, that's wearing off, that's ebbing. If for no other reason, also interest rates are starting to edge higher in the short term, and so you've got cash providing a viable alternative. Before, when cash was paying you nothing, which was essentially a negative real interest rate, you had a huge disincentive to hold cash. Now, while you don't have a wonderful incentive to hold cash, you're actually arguably getting a positive real interest rate. Today's PC deflator print of 1.7 versus, let's say, 2.3 in short-term fixed income. You're at least getting something. You're at least matching inflation, so that gives you the opportunity to sit and wait. Whereas before, you really had a major disincentive to sit out the market. I'm not saying you should be sitting out entirely, but you really have to decide now: are you a trader, buying dips, selling rallies, being opportunistic when they present themselves, or are you an investor and really start to do deep value stuff and look at your investments and decide, oh, this is a great buy at the 15% discount or 10% discount or 5% discount to where it was. That requires discipline. Don't mix the two up. They're different disciplines somewhat. And so buying something just because the price is lower doesn't necessarily pay off. If you believe with good reason that the price is too low based on your research and fundamentals and all the inputs that you take, that's wonderful. And you should be taking advantage of that. But trading and investing really gets separated in times like these, and you need to make a decision. Which are you? And if you're not sure which you are, you probably better sit out until you figure it out. Have a great weekend. Bye.